What's up everybody, Gen-X Dividend Investor here. In this video I share how I analyze and compare stocks to determine if they might be compelling to invest in. But first I want to do a shout out to Steve Doxa, who just clicked that join button to become my latest channel member. Thanks folks, I really appreciate your support. Now to kick this off, I'll caveat things by saying that in my video title, I ask which stock is better, though also keep in mind that better is a subjective term based on your needs and goals and risk tolerances, so just because I might favor one stock over another doesn't mean that you should as well. Okay, so it's not uncommon that I find people who will focus on stock price history when determining if a stock is good, and to be fair, over the long run a stock price trend is something that is valuable to understand. So I'll start with showing you some pricing data as a way to start painting the picture of a stock, but then we'll move into the real meat of what you should be looking at when you invest. In this case, stock A is trading at $189 a share, and from 1984 until now it has gone up a little over 611%. Stock B is at $42 a share, and it's up 463% over the same time frame. So if we just looked at stock price appreciation, then would conclude that over the last 4 decades, stock A has performed a lot better. But if I put both stocks into Portfolio Visualizer and backtest them, then we see something different. We find that had we invested $10K into both stocks and had been reinvesting dividends, then our $10K would have turned into $138K for stock A and $204K for stock B. That means that even though stock A had much more price appreciation, stock B had more dividends paid out, and so the total returns of stock B ended up being a lot more than stock A. Overall, stock A had a 7.11% annualized return over 4 decades versus stock B, which had an 8.2% annualized return. So 2 takeaways from that are: number 1, you can't always just look at stock prices over time and conclude that a stock has performed poorly, and number 2, a 1% annualized return difference between 2 stocks can be a substantial amount of money when compounded over 40 years. I mean, in this case, stock B with its 1.1% increased annualized return left you with 50% more total returns. So be aware if your tickers have big expense ratio fees, or maybe if you're working with a financial advisor, because a 1% expense fee can be a massive amount of money you're losing out on over your life. Of course, if you have an advisor, they may net you far more than the 1% additional returns based on their advice, though most professionals underperform the market, so my point is that you gotta think carefully about what you do. Anyway, here we see a portfolio growth graph for stock A on the bottom in blue and stock B on the top in red, showing you 10K investment returns in each over time. And then here's the dividend income each stock generates, whereas stock B in red is generating a lot more income than stock A in blue. Note that the farthest right column on this chart represents the year 2024, and its column is lower than the rest because we've only had a few months of payouts from this year so far. An observation you'll make if you look at the dividend payouts over time is that stock A has paid out and increased their dividend for about 28 consecutive years, though early on they had a hiccup. I believe that this month stock A will be announcing their 29th consecutive year of dividend increases. Stock B in red has paid out and increased their dividend for 17 consecutive years and should hit 18 later this year, so we're probably just 7 years away from also becoming a dividend aristocrat. Now I said 17 years because that's what its corporate website says, but when I looked at the payouts over time, it seems like they have 19 years, so either way it's getting up there, and a takeaway is that no site is ever guaranteed to be accurate when it comes to data. No tool is perfect, and obviously I can also make mistakes, so don't assume that everything I say is always correct. Okay, now let's look at total returns broken down into other time frames to see more interesting insights. So whereas stock A had a 40-year annualized total return of 7.1% versus stock B's 8.2%, if we look at just the last 5 years, we find that stock A has been doing really well with a 12.5% annualized return versus stock B's crappy minus 4.9% per year. Or look at the crazy 1-year returns of stock A at 52% versus 16% for stock B. The more you dig into things, the more it may influence how you choose to invest or not invest, thus take your time researching. Now a good comparison that I like to do is to put stock performance against that of the SP500. Google tells us that the SP500 was at 157 in 1984 and is at 5,204 now, which is about a 3,200% return. There's a nice annualized return calculator on buyupside.com that we can use to see what that translates to in terms of annualized returns, though realize it doesn't include dividends yet. Here we put in a beginning value of 157, an ending value of 5204, the number of years is 40, and this says its annualized return is 9.15%, which is about 3,200% overall. But I also know the SP500 normally yields about 1.5% in dividends a year, though over the long term it's averaged a bit more than that, so I could guesstimate that on average the SP500 has returned about 10% to 11% per year on average when we look at stock appreciation and divvies. Of course I could dig a bit more and get the exact annualized total returns for the SP500, but I'm just showing you how one could guesstimate things, which can be fine depending on what you're doing. Anyway, another takeaway is that the SP500 has outperformed each of the stocks in question over the last 4 decades, but don't forget that stock A started outperforming over the last 5 years. Okay, now let's dive into some other details. And for reference, stock A turns out to be IBM, and stock B is Verizon, both of which are well-known dividend stocks with long histories, and IBM is a dividend aristocrat. Now, some people might think you can't compare IBM to Verizon, but I'd disagree. I mean, you'll have times in your investing career where you'll have money you want to invest, and you may be looking at two different tickers in different sectors to decide what you want to do. But sure, comparing AT&T to Verizon is helpful, but you may have already compared AT&T to Verizon and concluded that you like Verizon more, and now you're trying to figure out if Verizon or IBM make better sense for your investment dollars and portfolio. Besides, the real value in this video is not about IBM or Verizon as much as it's to show you how I quickly like to analyze different companies. Now, one thing I like to do when I'm contemplating investing in a stock is to check what bulls and bears say about it in places like Morningstar and Seeking Alpha. Searching for IBM, I find the bulls saying things like, Number 1, companies using IBM mainframes and databases often have mission-critical systems and are unwilling to rock the boat by trying to migrate off them, which translates into a stable recurring revenue stream of established customers. Number 2, IBM's AI investments, like its Watson platform, should boost IBM's revenue along with should enable more IBM cloud adoption. Number 3, IBM should gain traction with its blockchain-based products as its network of logistics partners becomes harder and harder to replicate. And finally, number 4, IBM has a huge stable of patents that should provide them with various financial opportunities as well as defensiveness. On the other hand, the bears say that many of IBM's long-standing customers are trying to switch to cheaper competitive products. They also say that IBM's cloud offerings are weak in comparison to others. Like, this is Gartner's 2023 Magic Quadrant for strategic cloud services, where better means you're in the upper right quadrant and worse means you're in the lower left. Here we see Amazon and Microsoft as the top two best ones, followed by Google and Oracle, and then fifth is IBM, quite far behind. The IBM bears feel that it's just a matter of time until legacy mainframe customers migrate off their expensive IBM platforms and support. Finally, the bears point to IBM's revenue, income, and cash flow trends as areas where they aren't excited, and I'll show you specifically what they mean in a moment. In terms of Verizon, the bulls say that, number 1, a focus on network strength over the past 15 years has put Verizon in a solid position. Number 2, its wireless network provides the broadest coverage in the industry, and its reputation with customers is generally good. And number 3, it supplies passive income to investors with well-covered free cash flow. On the other hand, the bears say that wireless technology is dramatically lowering the cost to build and maintain a network, and that rival carriers have rapidly deployed new spectrum and technology to add coverage and capacity, and thus Verizon's network leadership is a thing of the past. Plus, they say that Verizon's total debt of over $150 billion puts it at too high of a risky position, even higher now than AT&T's total debt. And after reviewing what bulls and bears say, I like to dive into some key financial metrics, and I'll use my favorite stock analysis tool, FastGraphs, which I'm an affiliate of. If you use my affiliate link along with my coupon code in the description of this video, then it allows new users to get 25% off their first payment, even if you sign up for a full year all at once. Okay, this FastGraphs chart quickly tells me that IBM looks expensive right now compared to its historical PE trend, since its black stock price today is materially higher than its normal PE ratio in blue, as well as above the market's average PE in orange for slower growth companies like it. We see that IBM's dividend yield is 3.51% right now, and that its annualized growth over the last 2 decades has been 4.43% per year. It's involved in IT, located in the US, has a $173 billion market cap, and an A- credit rating. Now, a 3.5% yield is a decent percentage these days given stock prices have been pushed up, generally speaking. When I see over 5% yields in today's climate, then I'd expect it to be a sin stock or a REIT, or maybe a utility or something like a BDC, MLP, or maybe an income ETF, or perhaps just a beaten down stock, each of which has its own risks and issues to be aware of. 4.43% earnings growth tells me it's a slower growing company, as I'd ideally like to see at least 5 or 6%, though the larger a company gets, the harder it is to maintain a good growth. If I just looked at go-forward growth expectations, then it estimates a bit better at 5.27% a year. Like I said, IBM is a tech company, so another factor I consider when investing is what my overall sector weighting of my portfolio looks like relative to what I want, and my guideline is to push things towards what the overall market sector weightings look like, broadly speaking. Now, I prefer to invest in American companies, many of which also get some revenue internationally, as that allows me to benefit from the strong track record US companies have had and that I think will continue to have, as well as allows me to avoid dealing with some nuances of international taxation. I also prefer to invest in larger companies, thus 100 billion plus market caps, as that means they've probably been around the block and have managed to grow even through challenging times, along with tend to have high share volumes, which makes it easy to trade shares at competitive market prices. In terms of IBM's A- S&P credit rating, that's decent and it's considered investment grade. Here's a chart that shows equivalent credit ratings across different rating agencies. Credit ratings are forward-looking opinions about a company's relative creditworthiness. They provide a common way for investors to form a view on and compare the relative likelihood of whether a company can repay its debts on time and in full. Ratings are bracketed into 2 groups, investment grade on top, separated by a blank line, and then speculative grade on the bottom. Investment grade ratings mean the investment is considered solid by the rating agency, and the issuer or company is likely to honor the terms of the repayment. Such investments are typically less competitively priced in comparison to speculative grade investments. Speculative investments are high risk and, therefore, offer higher interest rates to reflect the quality of the investments. So the more conservative you are, the higher the investment grade you would probably seek. And a fun side note, J&J and Microsoft, both of which I'm long in, are the only two AAA rated companies in the world. Apple is close to them, with Moody's rating Apple AAA, but Fitch and S&P rate Apple one notch lower at AA+. And unfortunately, the USA's credit rating has been slowly degraded over the years, with Fitch and S&P having it at AA+, though Moody's still has it as AAA. Kind of funny and kind of sad that they estimate that J&J and Microsoft would be more likely to repay their debts than the US government. I mean, even the Lannisters always pay their debts. And when we compare the USA to other places, we find that there are 12 countries rated higher than the US's credit rating, including Australia, Canada, Denmark, and Germany, amongst others. Okay, back to stocks. If we look at this IBM FastGraph, we can see how earnings were rising nicely until 2014, then things started trending south, which you don't want to see, but then around 2021 things started turning around again to the upside. And since stock price often follows earnings, we see how IBM's stock price has kind of tracked like you'd expect, though as of last year, it started shooting up much faster than I would have guessed, taking it to where it is today, which is probably overpriced. Now let's take a look at some of Verizon's equivalent metrics. This visually tells me that Verizon looks quite cheap right now, as its current stock price is way underneath its long-term PE trends as well as under the market trends. We see that its dividend yield is a high 6.32% right now, and it has a low 2.9% annualized earnings growth, a $177 billion market cap, and a BBB plus credit rating. If you look at its growth, you see it's low and just kind of meandered up slowly over time. If I just look at go-forward growth expectations, then it estimates an even lower 1.4% per year. Now let's check out some dividend info with each stock, starting with IBM. This year-over-year trend shows that IBM's payout ratio was great until fiscal year 2020, when it went up to 75%, then 79% in 2021, but then it started trending down to 72% in 2022, and then about 69% in 2023. I personally tend to like most dividend stocks to be under 70%. Remember, the dividend payout ratio is the percentage of profits that a company pays out to its shareholders, though sometimes the payout ratio refers to the dividends paid out as a percentage of a company's cash flow. Okay, and another metric we see here is year-over-year dividend growth, and we can see that up until 2016 it was doing great two-digit increases, but since then it's had slower hikes all the way down to a low 0.61% increase last year. And speaking of dividend growth, my guideline is that I like to see at least 25 consecutive years of dividend increases, because that means that the company's made it through the pandemic, the 2008 financial crisis, and the dot-com crash, and still managed to keep paying and increasing their dividend each year. I call it a guideline and not a rule because I have some good stocks that aren't at the 25-year mark yet, like Apple and Microsoft. And if one of them decided to suspend or not hike their dividend, then I'd probably move those funds into something else, even though I think they'll continue to do well over the long term. If I wasn't retired and living on dividends, then I'd probably keep holding them even if they scuttled their dividend. Anyway, we can quickly look over this data and we see that every year has been a dividend increase for IBM, and if they had cut, then you'd see a negative number in red in the dividend growth percentage column, or if nothing was listed, then that means that the dividend payout went sideways that year. Like, take a look at AT&T's dividend history, and note that FastGraphs has 20 years of data in it. And we can see that in 2021, that T's dividend didn't change from 2020, and then it was cut in 2022. It also shows a negative red number for 2023, but if you look at the details, you'll see why that year actually wasn't a cut. Basically, in 2022, its quarterly payout went from 0.393 per share down to 0.278 per share, which came when AT&T spun off Warner Media. That's why they show negative dividend growth in 2022. But since 2022 had 1/4 of the higher pre-cut payout, and 2023 had 4 payouts at the lower amount, it makes it look like another small cut happened in 2023, even though it didn't. Thus, it's a good example of why you sometimes want to dig into details to understand things more clearly. Okay, now let's look at Verizon. Here we see a healthier payout ratio averaging around the 50% mark. We also see a generally lower dividend hike percentage, often in the 2 to 3% range. My portfolio's average weighted dividend growth is a bit over 6%, so I have some lower growers coupled with some higher growers, and ultimately I'm cool if I can beat inflation out over time. Now let's look at some financial statement trends over time, starting with IBM, and I'll just go over the basics. I usually like to look at income statements first, which show a company's revenues and expenses during a particular time period. You'll find revenue near the top of the income statement, and when people talk about top-line growth, they mean revenue, aka sales, have been increasing. But in this case, IBM's revenue trends don't look too hot. Note, these numbers are in millions of dollars, so like in 2023, IBM had $61.86 billion of revenue, better than its 2022 revenue of $60.5 billion, but then if you go back a few years to 2019, they were at $77 billion, and you can see how their revenue was even better in prior years. As we scan down the income statement, we see various expenses, such as cost of goods sold, and these various expense items allow you to understand profits at different stages based on what expenses are taking the biggest bite out of the bottom line. So bottom line growth means profits are growing. And note, net income and profit are similar terms, but are actually distinct. Profit can come in different shapes and sizes, such as operating profit, and may not take into consideration all the costs and expenses a business has incurred. Net income, on the other hand, is generally the last item on a company's income statement, detailing how much revenue is left after all costs and expenses have been taken into consideration, including COGS, administrative expenses, R&D, and taxes. I'll sometimes use the terms profit and income interchangeably, but I probably shouldn't. Anyway, the bottom line net income trend doesn't look so awesome. We see $7.5 billion net income in 2023, $1.8 billion in 2022, $4.7 billion in 2021, etc., and you can see how going back in time we average much higher amounts. Now, a weak financial trend doesn't always mean the company is bad, it's just something to understand and be aware of, and if I was serious about investing, then I'd look closer. Like sometimes you'll find companies that'll embark on new business strategies to enable specific goals they have, and so they sacrifice some short-term metrics in favor of long-term business goals. Sometimes businesses might even choose to close higher revenue but lower profit business lines in favor of focusing on what will enable their most growth. The takeaway is that numbers can tell you a story, but you also got to look deeper. Like if revenues are consistently growing faster than earnings, then maybe costs are out of control, or maybe management has gotten complacent. That's also why I like looking at various views of the company, like EPS growth over time, which is something FastGraphs has under its Fun Graph section, and here we can see a weak trend of IBM's EPS over time. Okay, now let's look at Verizon's income statement. Here we see a slightly better uptrend on revenue and gross income, but it's not great. I mean, 2023's revenue at $134 billion isn't much better than 2015's revenue of $131.6 billion. Looking further down and the trend looks okay. Not awesome, but okay. Maybe some low profit years for Verizon were due to upgrading their infrastructure, like going from 3G to 5G technologies, thus more money was being used for R&D or whatever. And then Verizon's EPS trend over time shows a better trend than IBM's, though not awesome. Okay, now let's take a look at IBM's and Verizon's balance sheets, which shows what a company owns in its assets and what it owes in its liabilities, along with the difference between the two, which is its stockholders' equity and which represents the book value of the shareholders' stake in the company. It's called a balance sheet because both sides of the equation must balance, i.e. assets equal liabilities plus stockholders' equity. Assets are listed in order from the most liquid near the top to the least liquid near the bottom. That just means assets that can be most quickly converted to cash are listed first. Liabilities are listed in order of immediacy, i.e. those that have the most senior claim on a firm's assets are listed first. For this video, let's just focus on some big items like total assets, total liabilities, and total equity, but all the data is interesting. For example, the first row shows cash and short-term investments, so we see that IBM has, in essence, $13 billion cash on hand. If you want to see crazy cash on hand, then look at Microsoft, who has over $100 billion. That gives them a lot of financial flexibility to increase dividends, pay down debt, and whatever they want to do. An interesting row on the balance sheet is intangible assets, which includes IBM patents along with goodwill, which is often when one company acquires another company for a price greater than its net asset value. Looking at IBM's total assets over time, we see an okay trend that has slowly grown. Of course, looking at assets in isolation is not as useful as looking at how its liabilities have also trended over time as well, which is further down on the balance sheet. Here we see liabilities also growing, and you can see how its total debt has increased over time. Just looking at the trends of asset growth to liability growth, I can tell that assets are growing faster, which is preferable. And for reference, all debts are liabilities, but not all liabilities are debts. Debt specifically refers to borrowed money, while liabilities refer to any financial obligation a company has to pay. Oftentimes people will look at different financial ratios, like debt to equity or whatever, to help get insights into a company's financial condition along with its operational efficiency. Okay, now let's quickly look at shareholders' equity, and it's good that it's positive overall because negative shareholder equity is often seen as a risky or unsafe investment. I'd rather that it was trending up over time, so it's not great, but not terrible, which seems to be kind of a trend that I'm seeing with IBM. And note when dividends are paid, then a company's retained earnings are debited and dividends payable are credited. That means that an amount from the equity section is moved to the liability section. Remember, dividends are not free money. Okay, and switching to Verizon's balance sheet, we see they have little cash on hand, but they do have a good amount of receivables, which is basically money customers owe them, and you can see that they have much more robust growth of assets over time, which is mostly from their property, plant, and equipment, which makes sense given what they do. Then moving down to liabilities, we see that they've been growing quite extensively, and that total debt is materially high, which is a concern of many investors. But their assets are large enough that they still have a nice growing trend of shareholders' equity over time. Finally, let's take a look at IBM's and Verizon's cash flow statements, which show where a company's cash comes from and how it's used to pay for operations and or invest in the future. By showing how companies manage the inflow and outflow of cash, the cash flow statement may paint a more complete picture of a company's ability to pay bills and creditors and fund future growth, more so than the income statement or the balance sheet. Cash flow is one of the most important measures of performance of a company, as it's the most transparent way to gauge the health of the underlying business. A decrease in cash flow due to sharp increase in inventory or receivables can signal that a company is having trouble selling products or collecting money from customers. Now, the first section of the cash flow statement is cash flow from operations, which includes transactions from all operational business activities. Cash flow from investment is the second section of the cash flow statement and is the result of investment gains and losses. And last is cash flow from financing, which provides an overview of cash used from debt and equity. I'll just focus on the free cash flow to equity line to move quickly, which is how much cash can be distributed to the equity shareholders of the company as dividends or stock buybacks, after all expenses, reinvestments, and debt repayments are taken care of. Here we see a decent amount, but the trend has kind of gone sideways instead of trending stronger. Let's take a look at Verizon's. And here we see a slightly healthier trend. And then another trend I like to look at is shares outstanding over time, which is part of FastGraphs' Fiscal Fitness tab. And we see IBM has a decent trend down, though they've not been as aggressive buying shares as of late. But IBM's shares outstanding trend looks a lot better than Verizon's, which just trends up. As a dividend-focused investor, I generally like to see shares outstanding trending down, making each of my shares worth more of the company, along with making my dividend payments more sustainable since there's less of them. And beyond what I just showed you, there are other things to evaluate before investing in a company. Like, is their business one that you think can keep growing? Are their competitors closing in on them, or do they have a strong moat? What sort of risks do they face, like huge litigation or risks of becoming obsolete due to new technologies? Who's on their management team, and do they have any red flags, or do they have strong names in the industry? The more you dig, the more you find out. So with all that being said, which stock is better? Well, that depends on your needs and goals and risk tolerances. Please leave me a comment telling me which stock you'd invest in if you had to pick one of them. Also tell me if you already own either one, or if you're thinking about investing in one. I used to really love IBM hardware as they had the best price performant mid-range computers out there, and they were really the only mainframe player in town. But over time I lost interest in IBM, though every so often they do something interesting, like when they bought Red Hat. Verizon's been a steady Eddie dividend payer and is well entrenched in the telecom space, but I'd like to see their debt going down aggressively before I'd seriously consider them. And with that, I'd like to close things out and remind you of both my FastGraphs link and coupon code, as well as my Seeking Alpha affiliate link, which often comes with benefits for new user signups, all of which are in the description of this video. And take a look at joining as a channel member, or check out my Patreon to see if it has any seats you want to join up for. Whatever you do, please hit that thumbs up button, subscribe if you haven't yet, and click that bell notification. Plus, don't forget to join my free Dividend Discord chat server, which has over 11,000 dividend investors on it from 81 countries around the world. Thanks for watching, stay positive, and I'll talk to you again real soon. Remember, I'm not a financial advisor, and my videos are for entertainment and inspirational purposes only. Investing of any kind involves risk. I'm only sharing my opinions with no guarantee of gains or losses on investments.